Biocon and Vodafone Idea, Vedanta, some of the top of the mind stocks this morning. So absolutely flat start. 19 points lower is what you have on the Nifty. 30 points now, 20 points lower on the sensex. So just trying to find its feet. 65 now on the sensex. So real rates starting to emerge and settling down. Mid-cap index is up 100 points, so that's about 0.2% higher, 51,250. And I think you've got the small cap index, which also starts flattish. The bank Nifty is down about 0.2% right now. Small cap ended strong yesterday, along with the mid-caps part of the market. And I think that is where bulk of the action is really once again at this point in time. So 30 points lower on the Nifty. It's a quiet kind of a start. Nigel.
That's right. For the broader markets, so plenty of stocks are reacting to news and reacting quite favorably. So let's run you through a few of them. Endurance Technologies, massive up move is what we're seeing on that stock. Volumes as well picking up, so good move is what we're seeing. Street likes the numbers, that stock flying away. IFL Securities, what a dream run this stock has had. In the last few years, I think it was around 20-25 rupees 4 years ago or so. Now it's at around 175 rupees. So the street likes those numbers. That stock is well up close to around 6%. Keynes Technology is flying away. Just take a look at that stock. It's up and about in today's trading session, up more than 10%. And that's actually the best earnings reaction that we've got this morning. Crompton as well, holding well in the green with a gain of close to around 4%. So big up move is what we're seeing out there. Alicon Castalloy, I recall explaining this company on Inside Out, around a month or a month and a half or so ago. That one has reported very strong set of numbers, and that one's up close to around 10%. In fact, Crompton is another one. Just take a look at that. It's building onto those gains. Big up move is what we're seeing out there. So fair bit of gainers from the broader markets. The headline index is flattish, but otherwise plenty of stocks moving around. Let's add to the list a couple of other stocks. Sangvi Movers, I'm not sure whether they came out with their numbers, but that stock has pulled back close to 7.5%. It saw a big re-rating, but that one is down in today's session. Surbhi.
I'm looking at InfoEdge, by the way. InfoEdge had a quiet reaction yesterday, but this morning there's a straight 5% pop that's coming in on that stock. So that's the big mover. And then some of these capital goods plays. The week has been all about the capital goods theme. So even this morning, there's a CG Power, which is up about 3%. A Hitachi Energy was looking at some additional gains. So these are some of the main ones. Even GE T&D, the stock has just been moving from circuit to circuit on a daily basis. So that theme still seems to be alive and kicking. But otherwise on the index, apart from the fireworks we're getting from Mahindra and Mahindra today, what a follow through really. Yesterday and today, 5% now on M&M. We'll be speaking to the management in just about 10-15 minutes. That's the big one. There's Tata Motors, there's Bajaj Auto. So autos is a big theme. But beyond that, once again, the issue is lack of leadership. And it is financials. It is large stocks like Reliance, ICICI Bank, Hindustan Lever, Infosys. So the big boys just not participating.
But it's a vibrant kind of market, right? In the broader markets, which is a good thing, and it's been that way for the last couple of days. That's fair enough. Voltas is down too. Just a few names on the downside. Voltas is down too, so keep an eye out on that one. 1292 is where that is. Sangvi Movers is down about 8%, so that's a large cut. 1178 or so. Container Corporation, again, a company we'll be speaking with in a bit. So stocks down about 2.5% or so. There is Honasa, which is, I think, coming up with some rates as well. Prince Pipe is down 2%, I think, again, reacting to numbers. GE Shipping is down about 2% or so at this point in time. Otherwise, it is auto day with Mahindra and Mahindra surging ahead, 6% higher. Stocks move on earnings revisions, right? Basically, you've got to just see whether the street is upping their earnings forecast based on these earnings. And in the case of Mahindra and Mahindra, as Sudarshan pointed out, right before market opening, we've seen that markets have upped their earnings forecast by between 10 and 15% on the EBITDA front, operating profit level for FY25 and 26. Crompton is up a full 10%, so keep an eye out on that one. That is as well. 373 on Crompton, and Titagarh, 10% yesterday. The management was on, and we really focused on the passenger coach business with Titagarh yesterday, and big plans, and 10%, another 6.5% this morning. Morgan recently initiated coverage on Titagarh a couple of days back. Dixon is another company which was with us yesterday, and they're talking about big jump, 18,000 crores in revenues in 24. They're talking about between 30 and 32,000 crores in revenues in FY25. That's another one which continues to react in a big way. Keynes is up 12%. Keynes, again in the EMS space, 28.69 on Keynes, a big 12% move. And I can start to see some of these, Garden Reach, and it's never one with shipbuilders, right? There's always Cochin and others would perhaps also would be there. So we'll see, keep an eye. But that's the market. Strong gains. I was talking about some of these bearing companies. Look at Schaeffler, 4% pop. SKF is the other one which had a big move yesterday. So NRB and a few others. So, we'll come back to some of these names, but it's a very vibrant start, really, as far as the broader market is concerned. So, what if the Nifty is not doing very much? Venugopal Garre is with us, head of India research at Bernstein. Venu, great to have you with us here. Thank you very much for your time. It's been a while. So, again, we want feedback from what you're hearing from your clients. You were in the US recently. I mean, you've basically been all over talking to people who put money here from overseas. So what's the feedback about the market? Of course, valuations is a constant complaint. I don't think that would have changed. But what's new is election. Does election come up in those conversations?
Thanks, Prashant, for having me on the show. Yes, I've had a fairly large number of conversations in the last 2 months, spread across various countries, centered around both foreign investors and domestic investor base. I would probably say that across the board, the fact that everybody is positive on India over the long term is more or less a consensus view. I hardly get any pushbacks these days on India or, for that matter, the India story over the long term. Valuations have always been a challenge, and particularly has been a much more of it because heading into this phase of elections, there has been some degree of euphoria that we saw in the markets last year. So to that extent, the only issue that I per se encountered is the fact that I did not anticipate FII money to be waiting on the sidelines or to chase momentum. Any fundamental models that you follow, which is based on analysis of numbers, long-term and valuations, you would always find it difficult to invest in a market like this. So this is like what is sort of stopping investors from participating in the India story as meaningfully as they should ideally have. So this is a broad sort of a take that I have in terms of how they're looking at markets. The second aspect is elections did feature as an important conversation point across the board. I don't think anybody was anticipating or expecting a change of government or trying to position for a change of government, right? So whatever challenge that you saw in the equity markets in the last month, I would not attribute it to an election-led impact, which is FII selling that you've seen. It's probably other factors as well, both in terms of valuations and how China has done over the last month. Part of that is election-led as well. So that's the sort of summary.
Okay. Venugopal, hi. Good morning. Great to have you on the show. Speaking of valuations, the debate on valuations will always have the E of earnings as well, right? And that's, what I want to ask you about, because in this quarter, there have been companies that have really delivered. Whether it's the capital goods majors like Siemens or an ABB or Mahindra and Mahindra today, and stocks are, flying even higher. So according to you, where is there still headroom? Because earnings are delivering, even though valuations may be elevated.
Yeah, so the way to look at this is that, firstly, there is no major earnings upward revision happening across the board. You're seeing some sectors seeing upgrades, some sectors not seeing any changes, and some sectors seeing cuts as well. It's a combination of all that. If you look at auto as well, I don't think Tata Motors would have seen an upgrade, while you're seeing probably M&M a marginal upgrade. Okay, so when you finally pull together consensus, you'll see 3 to 4%, sort of an increase and not 10%. So the reality is that overall for an index level across the board, be it SMIDs as well as for large caps, you're not seeing any earnings upward revision. Now, the second aspect is that growth this year as well as next year is going to be slower than the growth previous year. Now, the reasons are very simple. That previous year, the growth lift was also because of the impact of commodity prices being lower. I don't think that's something which is going to support us. If at all, it could be a risk as well. And that's the reason you're going to see YOY growth, of course, moderate through the next 2 years. Now, you could argue that the growth itself is slightly higher than what we used to have a couple of years back. That is true. And that's the reason why market valuations are also high. The second aspect of this is that both for Nifty as well as SMIDs, they're actually pricing in this high growth to sustain for a very long period. Now, which is where the risk is that you're not going to be seeing such high growth sustaining for a long period. So we do need sort of some form of a flatlining of the markets for a while or some corrections to see a much larger interest in terms of investors coming in. And the last thing I want to highlight is remember that given that the optimism in general is fairly high, you're going to be seeing a lot of fundraising activity in the market, which is going to be tremendous in terms of size and scale over the next 12 months, which sucks in the liquidity as well. So that's the other challenge.
So more block deals ahead is what you're anticipating.
It's across the board, block deals to preponement of IPOs, which should have ideally been done 3 years later. You will basically say, hey, why not do it now? So it's going to be swath of IPOs plus blocks, which could be private equity sales to fundraising by corporates, because any CFO, when they look at the market, would prioritize probably an equity fundraising over anything else at this juncture because equities are cheap from a fundraising point of view.
Hi, Venu. Good morning and good to see you, Vin. I want clarity on a couple of issues then. You sound a little bit cautious on earnings. So what are you factoring in? The street is at around, low to mid-teen growth. What are you factoring in earnings growth here in India? And also, I was reading an earlier note where people are talking about 400 seats and you said mathematically that looks a little bit challenging. But do you think the street will be okay if you get a simple majority for the ruling BJP-led NDA?
Yeah. So the first thing, on the earnings point of view, I am basically of the view that Nifty 50, which is the main index, is probably going to be in the mid-teens to slightly below mid-teens range. And of course, it will be a bit lower than that for next year, FY26. While for the broader mid-cap index, which actually on my bottom-up growth was more than 30-35% last year, it crosses somewhere in the 20-25% range this year and 15% range the next in FY26. So that's the broad spectrum of earnings. Last decade, mid-caps probably saw 12% growth and 8-9% for Nifty. So we are still above the last decade growth rate, but of course, I don't know if that's the benchmark, but much lower than what we delivered last year. So that's like the broad earnings spectrum. What is getting priced in the market is 13 to 14% Nifty growth for the next 15 years. And 18% for mid caps continuously for the next 15 years, right? So that's what I meant as to what is getting priced in for the long term. Now the second thing is that go ahead.
Yeah, please go ahead. You were going to tell us about, do you think the street will be okay about a simple majority for the BJP?
Yes. So the second part, of course, is your, I think anything which is a majority is good enough. That's the way I would characterize it. Because look, honestly, you don't need 400 seats. It is not that you need such a large mandate to change anything. See, it's good to have a large mandate because, opposition benches would be much lower. There'll be sort of more confidence in the government to execute things. But if you get 400, are you going to bring back farm laws? You're not going to do that, right? So that mandate is actually of not much, implications for market. Anything which is a decent majority is good enough in my view for the markets. But remember, markets are anyways pricing in a decent majority. Markets may not be pricing in 400 plus because that's euphoria. If you see 400 plus for any reason, which I think mathematically is not possible, you'll probably see the markets crossing 23,000 from a Nifty point of view for a short period in that euphoria. If you're in the 300 to 350 range, I don't really see much of a market movement at the 2,000 plus range, right? So, and we're not pricing in, of course, a change of government for sure, which is obvious.
Okay. There's an order for BEML, again, another one which has reported a fantastic set of numbers recently and really great going there. Venu, you used to track autos, right? You still do?
Yes, I still do.
Just a word on, the Mahindra management will be with us in 10 minutes. Anything you want us to ask them? Superb execution, right?
Yeah, I guess, no, the execution is superb. We have an outperform rating on that as if I were to just disclose that. So we have a buy on that stock and pretty happy that they've done well. See, the broader perspective as to why this stock price movement has been so intense is primarily because the previous quarter was expected to be weak because tractor volumes were so bad that there was a worry that this is going to actually impact numbers. But our broader thesis purely, from this particular stock or space was the fact that over the years we had observed that while tractor was a major driver for the stock price movement, last year we had argued, back end of last year, that look, tractor is no longer an important driver. SUV is the important driver because it's very, very important business in terms of profit contribution. So in that sense, we felt the drivers are changing and we shouldn't worry about tractors. So that's basically it. From a management point of view, I think what you need to ask is more centered around their pipeline. More centered around the pipeline in electric vehicles and what they're going to do there. I think the market narrative in a couple of years or probably in 12 to 18 months to shift towards success in EVs.
And that's why they're putting the money. 12,000 crores is the the cash that they're pumping in on the EV story. Venu, just a quick clarification. You said that you are expecting low to mid-teen returns for the Nifty in FY25, right?
No, I actually meant earnings. It's 13 to 15% growth for Nifty earnings. My Nifty target is 23,000. If at all it really is of any value, it's 23,000. Which was 8% return YTD. Yeah, 8%.
That's why the clarification. Yeah, because I kind of eyes popped when you actually said 15% Nifty return this year. Got it. So that's mid-teens earnings return.
Why surprised?
Because half the year is kind of done, and we're not. I'm yet to come across someone who's been as bullish on a 15% index return.
People of little faith.
Perhaps.
You would be surprised with 15%. Why?
He's saying 23,000 on the index. He's in that
I have only 23,000 as my target, which was actually 7-8% return year to date, which is what I had modeled. See, if broadly Nifty hasn't done much in the first half, so since I'm not really revising my target for Nifty, I'm basically talking about positive returns in the second half, which is actually good enough. But remember, with all these returns, you're going to see a lot of volatility as well. See, the point is, if there was no primary market activity, if you're going to be having this kind of an earnings growth, which is mid-teens, no primary market activity, which is no major fundraisings happening in the market, then flows itself could have led to a breach of the target. But I do anticipate at every point of time, big chunky fundraisings happen. So that's going to start liquidity.
Just one more data point on the elections. Every year, every calendar year in the last 4 years, you've seen double-digit returns in an election year. It could vary.
Before the result, after the result.
No, for the calendar year. 2019 is around 12%. 2014 was obviously out of whack and earlier. So double-digit though.
But the difference is every election period you had seen the pre-election year period being weak returns, and this is a unique year where we had very strong returns in a pre-election year. That is because everybody is smart. People realize that they read patterns saying, election year returns will be there, let's buy before. So people bought before.
But it always depends on how you slice and dice the data, right? Someone who's watching it only from a calendar year perspective will say, what is this? There's nothing. There's no pre-election rally, right? But anyway, that's a debate that can continue. Great to have you on the show. Thank you very much for joining in, Venugopal. Very, very, interesting conversation as always. Well, let's quickly move on and now focus on some more earnings. We have Krishna Institute of Medical Sciences on the radar. The company's Q4 margin contracted while occupancy declined, although they registered a good growth in average revenue per occupied bed. B. Bhaskar Rao, Chairman and Managing Director, Krishna Institute of Medical Sciences, is with us now. Thank you very much for joining in. Occupancy for the hospital this quarter declined both year-on-year and quarter-on-quarter. Why is that?
See, the occupancy, the decline is due to what we have done in Sunshine. We are shifting the old premises to the new premises. During that time has come, and it has come back now in the last 2-3 months. So that is not a big major junk. And the second important thing, because of the elections of last time of the Telangana elections and as well as the cyclone in Andhra has been affected very largely. That is the reason the occupancy has come down.
Well, Mr. Rao, the average revenue per occupied bed saw good growth of around 11.5% on a quarter-to-quarter basis, 12% on a year-on-year basis. What led to this double-digit growth?
So the reason is that the ALOS, average length of stay, was 4.11, has come down to 4.01. And also the payer mix. We have reduced the state government insurance like 1%. That has increased the corporates and as well as the cash and insurance business. So the payer mix and as well as the clinical mix and also the ALOS. These three factors has increased the ARPOPs and the average revenue per operating bed.
Right. Mr. Rao, what are you guiding for FY25 on occupancy and average revenue per occupied bed?
The RPOPs will still, there is a growth will be there in both in RPOPs, and also we are trying to implement in the ALOS as well. And also we are planning to change the case mix and as well as the pair mix. So definitely there will be whatever is the growth we have seen in the last RPOPs and as well as operating bed that continue to grow in the next year also, coming year.
Okay, sir, margins came off over last year. Can you just tell us the breakup in EBITDA in the new hospitals and the older ones as well? And what's your guidance on margins for FY25?
See, mostly the newer hospitals growth will be on a single digit. Now this year is actually in Q4 of coming this year. We are going to open up 2-3 hospitals that may able to drag down the EBITDA when compared to the total. But the existing hospitals growth will be single digit.
All right, Mr. Rao, what was the surgical revenue as a percentage of your total sales mix? Have you seen an increase in high-end surgery work in your hospital?
Yeah, surgical business has increased when compared to the previous quarters and year on year, about few percentage. In more and more, we are going to add, and we are also adding the new therapies, which is a non-surgical and as well as non-medical. There will be more of a interventional radiology and other procedures that will able to help the growth.
Mr. Rao, what is your sense on the possibility of this proposal, right? Standardization of procedure rates in hospitals. Where is that conversation at? Or do you think, it'll only happen once elections, etc., are over? Go on.
No, basically that last time also I mentioned it is very impossible to uniform rates and sensitization because every patient is different. Even though they come with the same symptoms and signs, but the underlying causes will be different. So we need to be able to treat according to that. It is a complexity of each patient is different. So we cannot able to make it a uniformity. And if it happens, as we have seen in the past, in the last quarter, most of the private equity people who want to invest in healthcare were showing a good investments in the last 1 year. They will not able to come back and try to invest, and the industry itself is going to be in trouble, and as well as the quality care will come down. So I don't think that will be an implementable solution. But only thing is they can able to come up to improve right now the pricing of central government schemes and state government schemes. If they can able to scientifically, if they can able to do the tariff, that also help the organizations to grow much better than what we are today.
Sir, speaking of how much governments are paying, let's come to the the billing mix as well between different payers. So what is that current mix between the billing that you do with insurance companies, outright cash payments, and then, of course, all the government schemes and the government component in your revenue mix? And what's expected for the current year?
The insurance and cash is around 80%. The corporates and the Arogyasri scheme is around nearly 20%. Where the Arogyasri scheme, which is a state government run scheme, has come down to 1%. The corporates has gone up 1%. And also the revision rates of insurance has been started. That's why the RPOPs has increased. Usually it will be once in 2 years we will review the insurance rates. It's supposed to happen last year. Usually it will take a long time to renegotiate with them. That has been materialized in this quarter.
All right, Mr. Rao, we leave it there. Great conversation as always. Thank you very much, and hope to speak with you soon again. But that is the result from KIMS and the outlook that the management has chosen to put forward. Market is not doing very much. We're down about 40 points right now, 22,364. It's just holding on. Mahindra and Mahindra is the top gainer with a 7% pop. This is just an incredible sort of performance once again. And if my memory serves me right, we've had, M&M is, at least the stock is making it a bit of a habit to jump up sharply post results. So, expectations now, of course, running high in terms of what they'll be able to do from their ICE SUV portfolio, but also electric vehicles, which is likely to be a big focus area. So let's actually invite the management of Mahindra and Mahindra in to talk about some of this stuff. There is, of course, also their investment, which they've announced, 12,000 crores. Rajesh Jiturikar is ED and CEO, auto and farm sectors at the company. Rajesh, good morning. Great to have you with us here on the program. Prashant this side. As I said, you're setting the bar high for yourself with performance. We are seeing earnings upgrades, etc., coming in. Your guidance for 26 looks pretty good. So I guess I want to ask, how are you doing it? But even if you want to choose that, you want to answer that, you can do that. But let's just get specific a little bit. On the SUV side, you've got open order book of about 220,000 sort of vehicles. Just tell us how that is growing, what is happening, what are you what will you end up with by the end of the year? What is your expectation there? Because that is the big growth driver, UVs and SUVs.
Morning, Prashant, and pleasure to be with CNBC this morning, and thanks for having me on the show. Yes, we do feel good about the results that we put out for F24 and for the quarter as well. And as you rightly said, the auto business has been a key driver of performance. We've seen some very strong momentum on the auto side, on the margin management, but as well on the performance of our SUV and LCV portfolio both. So if I was to now, go more deeply into the question that you've put out, what's happening on the SUV portfolio is we've had some very successful launches. So I'm just going back a little in time. The Thar did very well. Then we had the XUV 700, which did very well. We launched the Scorpio N, which did well. And then we also had Scorpio Classic to continue and also stay in momentum. We've recently, on the 29th of April, launched the XUV 3XO. And that, again, has got a very, very exciting response, if I may use that word. We opened bookings on the 15th of May, and we got bookings of over 50,000 numbers in an hour. A lot of excitement in our showrooms, even now as we, it's a weekday, it's summer, but, showrooms are running full. So even on weekdays, we're seeing a lot of excitement. It's a very strong value proposition with a very, very many exciting firsts in the category. To the specific question on the 200,000 plus booking number, 50,000 of that is what we've added through the 3XO. But again, like I said, the Scorpio portfolio remains very strong, and our existing products remain strong as well. We do want to bring the size of this booking number, open booking number, down, because we don't think that is what customers want anymore. Over the next few months, our focus will be on using, ramping up as much as we can to bring the waiting period down for our customers. And on the 3XO in particular, we already have produced 10,000 vehicles, and we'll start deliveries on the 26th of this month. Back to you.
Okay, all right, Mr. Jiturikar. I'm very sure that a lot of your customers will be very happy to know about the delivery timelines. Just a little more on the sort of the way this whole SUV portfolio is playing out for you. I think you ended the year with a market share of 18%. Where do you see this moving, considering the strong demand? And also tell us about what the levers will be in terms of, adding to the top line on the automotive segment. Is it going to be more volume-led growth? What about pricing? I mean, blended pricing on the SUV portfolio, what was the increase in FY24? And do you think you can push through more price increases because there's such strong demand?
Hi, good to be with you. And the way, let me try and break this up. Firstly, the SUV growth expectations we've put out for F25 is mid to high teens. That's on the back of what we believe has been a good 3XO launch, and also a new Thar, which will come later in the year. So we do have two new products which will help us get to mid to high teens. So We think this will be a much higher growth than what the industry will have in the year F25. We would aim to gain market share. To put market share in context, we look at it on two parameters. We look at revenue market share. We do that because our average selling price is way above the industry average. So we do look at what our revenue market share is, and we've been number one by way of revenue market share over last many quarters, including the last quarter. We are number two by way of volume market share, and given the fact that we are very specialized, authentic, adventure-ready SUVs, being number two in an industry which is now 60% of the passenger vehicle market is, I think, very, very credible, and we feel good about being able to be at that level of market share. Coming to the price increase question, we have taken price increases through the year, managed our costs well, and that's helped us get a very good margin increase by way of our auto margins. As you see in Q4, we improved the auto margins to 8.8%. There is this very thin line on what's the right extent of price increase that you wish any player should take or any brand should take. And we always believe that's got to be very well calibrated. We have to make sure we don't lose our strength. Our strength is that we offer a lot of technology and a lot of features at a very good price. And I don't think we're going to do anything to, take away the basic brand strength, which is our ability to do that. So, short-term price increases can seem very good to get a bottom line impact. But over the last few quarters, what we've demonstrated is our ability to keep growth going, keep demand strong, and to manage our margins through a combination of pricing and costs.
All right. Hi, Rajesh. Good morning and good to see you in. This is Nigel on this side. I get a little bit nervous when you launch a new XUV. I'll tell you why. Because you get a lot of calls saying, can you help us with the delivery? Because it's going to take a really long time. The waiting period is 7 months, 8 months in the past. But that's on a lighter note. Phenomenal growth is what you'll have seen in the XUV business. So good on you. Let's focus on tractors, though. We have an election. There has been some kind of slowdown is possible in the first half of the year. But for the year, the industry growth is what you're penciling in around 5%. Will you outgrow the industry? And if yes, what does it take your market share to? Because I think it skimmed off a little bit by 100 basis points at around 39.5%. Tell us more about the volume growth you're targeting and market share in the tractor segment.
Hi, Nigel. So let me get the market share question out of the way first. So for the full year F24, we grew market share by 0.4, which is 40 basis points. That is a very credible achievement given that we are already 42% plus kind of player. The Q4 is explained by a decision we took to, moderate our level of stock and bring it down to appropriate levels. So it's a stock correction call. It's not a loss of retail momentum. In fact, in April, the tractor market share gained significantly and was at a level of over 46%. So the quarter market share of Q4 is just an aberration based on a stock correction decision that we took. I'm talking about the dealer stock correction. We have said that the growth for the industry will be 5% for the year F25. There are several positive drivers at the moment, the most significant one being the monsoon forecast, which show a reasonably good spread, a good timing, and except a couple of states, I think the rainfall will be overall good. The other positive sentiment is the farmers' terms of trade, where output inflation right now is higher than input inflation, and that really enables the sentiment of farmers to buy and starts bringing cash in. We expect the second half to start picking up growth momentum. So you did talk about elections. We don't think election fundamentally disrupts demand. It's just aberration and there's a deferment. This is a buying season, and hopefully, June will see a recovery, but May does see some kind of a disruption because many people are busy with electioneering. Second half of H2, given all the positive parameters, should see a positive growth. Based on how the monsoons start coming in, we may put out a new forecast in July, but at this point of time, we are seeing the industry at +5, but many, many positive, green shoots, if I could call it that.
Okay, all right. So we've got that out of the way. Then tractor industry growth at 5%. Explain to us why Q4 is a bit of an aberration on market share for tractors. Let's focus on the EBIT per vehicle. Now that as well has moved up. For autos, it's holding at around the 92,000 mark. And for the farm equipment space, it's at around 115,000, which has moved up as well. Do you think you can better both these two numbers on a per vehicle, EBIT that you're making?
Yeah, so Nigel, without giving any kind of guidance, let's look at and answer this question with a demonstration of our track record. We have improved our EBIT margins significantly over the last few quarters, and the tractor EBIT margin continues to be strong in spite of a volume downturn, which really is an indication that we are doing many things to manage our costs well and the balance between pricing and cost. There has been, commodity prices have been a bit benign too, and that's helped us on the tractor side in particular in Q4. We would keep the balance right between growing margins and keeping demand, market share, and volumes intact. And that's really, what we would aspire to do, that keep improving our margins with the right actions, a high focus on cost management, appropriate pricing decisions which don't disrupt our ability to grow or lose the ability to gain market share.
Right. Rajesh, let's just talk about electric vehicles, right? Because that's going to be the next, it's a new thing, maybe not exactly a completely new thing. But you've got big investment plans. I mean, over 25 and 27, I think you're looking at spending some 37,000 crores. That's the investment you will make. It's a big step up from what you've done between 22 and 24. I think you're saying that there will be some, I think 7 new sort of electric vehicles, although you've spoken about this in the past. Could you talk to us a little bit about this? How is the thinking evolving? Is this investment largely going to go into the electric vehicle sort of space? And, is the model there set? Because penetration here in India is still very, very low. So there is a risk of being very early also. So you've got to kind of calibrate when some of these products are developed and hit the market. Globally as well, in some of the big markets, EV sales, EV penetration maybe is just cyclical, has kind of stalled. Just your thoughts, Rajesh, briefly. Go on.
Super. So firstly, just to clarify, that 12,000 crores out of 37,000 crores is the, so 27,000 we said is the total auto capex over the 3 years, and 5,000 was for the farm equipment business. Out of that, 12,000 crores was for the electric SUV portfolio. We believe that, we as a leading auto OEM in the country and, with global aspirations as well, need to make the right investments to create future-ready product portfolios. And we've been working on that over the last couple of years. A key part of that is creating a new InGlow platform, which is a born electric platform. We have showcased some of the products that we will bring out through 2025, 26. And we believe that, as a leader in the SUV space, really, we would want to play a critical role in growing the electric vehicle category. Categories grow when you have exciting products. We've demonstrated that on the ICE SUV side. We believe that our exciting product offerings is what has been the key driver for us to gain volume, gain market share in this segment. We will be hoping and aiming to do the same with our born electric EV portfolio. We would start launching products in a calibrated way starting in the Q1 of calendar 2025. The products really do have standout design. They're going to be very high on tech and software, and are really fun to drive. The electric is quiet and they have excellent acceleration and pep. So we remain very excited about the opportunity. You also spoke about, the EV penetration in India with, as compared to around the world. In India, it's at a very, very nascent stage. Countries around the world are seeing some kind of slowdown after they've crossed 15-20% penetration. We are at 2% penetration. So there's enough of an upside. We believe that by 2027, 20 to 30% of our portfolio will be electric in the SUVs. Given that the balance 70% or 80% will still be ICE, we continue to invest in exciting ICE products because that will still 3 years from now be a critical part of our portfolio. So in a way, we would have a very strong ICE and EV portfolio 3 years from now.
But Mr. Jejurikar, will there be any cannibalization, sort of EV eating into ICE as the new launches roll out? I mean, that's a little natural to expect, right? How do you see both playing out starting that first quarter of next calendar year when we get the EV launches from M&M?
Yeah, so of course there will be some cannibalization. I mean, we don't rule that out at all. And that's something we're comfortable with. As we've shared, not necessarily at the date of launch, but as we have on our ICE product portfolio, we do build margins incrementally as we build volumes. We would expect on a steady state basis, the margin per unit of ICE and the margin per unit of electric vehicles would be the same. Now, not as a percentage because there is a denominator effect, but as a per unit margin, they would, on a steady state basis, like to like be comparable. In which case, we won't worry about cannibalization. We give customers the choice. And one of the reasons we've decided to sell both ICE and electric from the same dealerships in the same showrooms is to give customer the choice of whether they want to buy our ICE portfolio or our EV portfolio. And customers will choose based on their needs. A lot of our customers are multi-car owners, don't hence have to worry so much about range anxiety, have charging infra at home and in office. And of course, the new portfolio has a very, very good range as well.
All right, Rajesh, appreciate you joining in and giving us clarity on the SUV part of the business, the tractors, as well as some color on the EV business. Wishing you all the best for FY25. FY24 has been a star, as the stock price is telling us. Well, for the time being, though, we'll have to slip into a short break. You come back, we'll get chatting with the management of Concor. Don't go anywhere. Welcome back. This is Corporate Radar. Well, as promised, let's get straight to Concor's Q4 numbers. He reported a mixed set. The volumes came in better than realizations. Their margins also improved. Mr. Sanjay Swarup, the chairman and MD of the company, joins us on the show. Good morning, Mr. Swarup, and thanks a lot for joining in. Well, for the past year, your volume growth was around 8% odd. Earlier on, there was some kind of skimming down of guidance, but that's about the past year. Going ahead for FY25, what kind of a volume growth can you guide us? And if you could break it up for us between EXIM and domestic.
Yeah, good morning. We are expecting a very good growth in this FY25. In EXIM, we are expecting around 15% growth. And in domestic, the growth will be around 25%. So overall, we are expecting a growth of 18 to 20% in this financial year 25.
Right, got that. So, hi, good morning. Prashant this side. Mr. Swarup, how were realizations in the fourth quarter in both export and domestic versus last year?
Yeah, realization have seen a good growth in this fourth quarter as compared to the Q4 of FY23. And we are seeing a good margins and good top line growth. In fact, the Q4 of this financial year has been the ever highest in the company's history. And it was the Q4 of 23, which was ever highest. Now we have broken that record. And we have posted a highest top line in this FY24 Q4.
Mr. Swarup, I wanted to understand your strategy going ahead. Because there was a report that I read from BNP Paribas, a couple of months or so ago. They were talking about your realizations, your pricing being relatively higher than some of your peers. And that's what could lead to some market share lost as well. So what's the strategy out there? Will you look at skimming down on pricing to go for market share? And in that context, what is your market share?
See, it has been the company's strategy to give best service to our customers at reasonable cost and without sacrificing any of our margins. So that strategy will continue in this FY also. We will not be compromising on our margins, but we are giving more and more incentives, more and more facilities to our customers. Like we have adopted IT in a big way. Logistics app has been a big help for first mile, last mile connectivity. Similarly, at our flagship terminal, we have adopted AI-based terminal management system. And we are actually giving all in all these services to our customers, which have been welcomed by them. And we don't sacrifice our margins. But of course, if due to our operational efficiencies, we save some money, part of that we share with our customers also. But that doesn't mean that we sacrifice our margin. Our margins remain intact. We are operating at an EBITDA of around 25%, which is in the logistics sector quite reasonable, quite handsome. And we continue to be maintaining EBITDA around this number only.
And you were going to tell us about market share as well. Have you lost some market share? Is Gateway higher in select places?
Actually, we have not lost market share. As far as the rail-based containerized transportation is concerned, we are maintaining a market share of between 60 to 65%. This we have been doing for the last 3 years, and we are very hopeful that we will continue to maintain this market share and maybe gain some market share because of the new products that we are going to introduce in this financial year.
Okay, got that. This is for the rail-based containerized segment, right? 60-65%. And you're
Yes.
saying you may look to gain as well. Could you tell us what is your share of revenue from value-added services and what's the target going forward?
See, value-added services constitute an important part of our service to our customers. We have introduced a business solution segment 2 years back, which has been a very successful initiative of the company. It's a sort of vertical integration to our already services that we were giving to our customers. It involves the various end logistics like first mile, last mile, giving custom clearance facilities, fumigation, everything we do at our terminals. It has been welcomed by our customers. And of course, it gives us a reasonable amount of margins as well as revenue. At the moment, I cannot share that number because I don't have it with me right now. But it gives us handsome margins as well as top line to us. And customers also, prefer these services to be given by Concor rather than going to any other operator.
Okay, all right. Mr. Swarup, one tricky aspect which the street is a little bit skittish on is the LLF. That's the land leasing fee. I'm looking at a release and there's a demand coming for 3 of your terminals that amounts to around 700 crores. So tell us how, is it resolved, the understanding that you'll have, or is that still far from resolved out there? The demand is close to 700 crores. Give us some color on that as well.
See, LLF demand is not 700 crores. I don't know from where have you got that number. LLF demand is around 400 to 420 crores. So we are very much clear on that, and we have resolved this issue with the Indian Railways. And this is a 7% growth in LLF every year. And it's a continuous exercise in my company to surrender the railway land, which we are not using, or which we find that it is not giving us the due returns. So that exercise is continuous, and we are surrendering the surplus railway land and without losing any business. And we are commissioning more and more terminals, purchasing our own land. So this has been a continuous exercise by the company. And this year also we have commissioned 3 MMLPs at Jajpur, Kadakola and Paradip. And this exercise will continue in FY25 also.
All right, so I'm looking at the page 11 of your release, Pilor, Tungla as well as Murabad. If I group all these three numbers together, the key audit matter that you have written about, that summation of three of them comes to around 700 crores. So I asked you that. But you're saying that that's resolved, right? There's no issue. There's no need for the street to be worried about
that
this.
That is fully resolved. Yes.
Okay. All right. Well, thanks a lot, sir, for joining in. I think we've got most of the deal. Just one more question if we can squeeze in before, we let you go. Any update on the divestment post the election? Should we expect something?
See, that is the policy of the government. We are following the guidelines that are being issued by the government. And if there is any update, definitely you will get it.
Okay. All right. Mr. Swaroop, we'll leave it there. I look forward to getting more updates from you as we go along and, for another chat. Thank you very much for joining us here on CNBC-TV18. You got the market, which is flat, absolutely flat. 3-point change is what you have as far as the indices are concerned. Mahindra and Mahindra is still the top gainer with a 6.5% gain. Crompton is not up 10, it's up 13 now. So it's kind of moved up even more. And there is Dixon, which is up 6%. It's a new high. Stock's almost at $9,000 with the move that we have. And of course, some of the other stocks, there is a lot of new stuff in the mix. Hindustan Zinc is up another 5.5%. There's a fair bit happening. It's a very healthy, vibrant, broader market screen that you have. 2:1, actually more than 2:1 is the advanced decline ratio. But I think we have the next management with us.
Absolutely. And Akzo Nobel is the stock on our radar, the maker of Dulux paints. Now, the performance was more or less in line with street estimates, and it was a little muted the quarter gone by. The revenue growth was just about 2.5%. Yeah, there we go, 2.3% on the upside. Gross margin, however, did expand, and profit also saw a fair amount of growth. We have Rajiv Rajgopal, Chairman and MD of the company, with us right now. Mr. Rajgopal, thank you so much for joining in. Let's start by talking about top-line growth first. So, fourth quarter, 2.3%. Just take us through the consumption trends. What was the volume growth, first of all, in the fourth quarter? And FY25, are you expecting things to improve? What's the volume expectation for the year as a whole?
Thank you, Surabhi. Good morning to you and all your viewers. First and foremost, yes, I think it's very misleading because you see headlines. We've had a solid volume growth. The volume growths have started coming. Our volume growths were almost to the tune of 15%. Now, there are two reasons why you're seeing hence the revenue growth of 2.3%. One, the industry has seen a price drop, as you know, between December and January, which is reflected in this quarter gone by, of almost for us almost about 4.5%. Right, so that's one. The second is the mix has been adverse. And I think you've seen it in all the industry results that have come in, that for us, it's so far, and we've seen it in the full year, the premium category actually outgrew. But if you look at the quarter gone by, it's basically the mid-market, the mass, and the economy, etc., which have done very well. As a result, you're seeing the dilution of the mix, which is the reason that you've seen the revenue, particularly from a paints perspective, the paints vertical perspective. Similarly, we've seen similar trends happening in our coatings vertical, particularly if you look at automotive. We are not in the OEM, so we've not had that dramatic jump that some of the players who are in the OEM business would have seen. In the aftermarket, we've seen in that category, our premium has grown, but our mass has been a little curtailed. So we've had a bit of a mixed bag in the last quarter. Suffice to say that, I think the trend is right because I'm really looking at underlying volume growth, and both, for the quarter and the full year, the underlying volume growth for the company has been double-digit. That's fantastic. So you're saying 15% volume growth in Q4. That's and what was the total number put together for FY24? And then, we can then discuss FY25. It's almost 10%, so it's for the full year. And that's the reason why we believe that we are slowly coming back. See, you must realize, as far as Akzo Nobel is concerned in the paint side of the business, we were at significant premiums to the market player last year this time. And one of the things that we wanted to do is to correct that premium, right? And move from a price-led revenue strategy to a volume-led revenue strategy for the next 2-3 years, because that's important and an imperative given what's going to happen in the paints industry. But what about the price decline? Just a quick final question to complete the point that you made. I think you mentioned that the price decline in Q4 was 4.5%, right?
So that, for your investors, is going to be a slightly worrying trend. Is that continuing into the first quarter? What are the factors at play here?
Well, look, the industry had taken a price drop, and obviously, given our market share, and the fact that we've gained market share in a full year period, we were very clear that we are going to fight tooth and nail to make sure that we continue and build and consolidate our market position. Now, is it a worrying trend to your question? I don't think so. I think one of the reasons we could afford to do that, and you've seen it in the results, you've seen that our EBIT margins have actually grown in the quarter Q4 and also in the full year significantly, is because of the fact that the raw material was benign. Now things are sort of flattening and moving up a bit, so I don't see that happening further. And we will see. We will have to take, as they say, one ball at a time and play the match. But we are very clear we are going to consolidate and build our market position. If you look at our EBIT margins, Surabhi, we are almost at a 14-15%. Remember, this is including royalty. Yeah, so effectively, when you look at the market, we are virtually number 2 in terms of the shape of the business compared to, even some of the larger players. And that's in a good shape. If you also look at
Rajiv, hi. Sorry, we just sorry for the interruption. Just let me get a question in. For FY25, what kind of volume growth should we pencil in?
Double digit.
It could be 10%. It could be anything. I mean, would it be? Where will you be? Yeah.
12 to 15%.
Okay. 12 to 15% volume growth. And what about margins, Rajiv? I mean, because you're saying that you'll focus on volumes now, and we've heard this from Berger, we've heard this from Asian Paints, that, essentially it's going to be volumes. I mean, the volume value differential it varies between 2 and 5-6%. So just wanted to get your sense. Yeah.
You're right. Look, the volume is going to be about 12 to 15. The revenue will be in the high single digits. Now, whether it's going to be 8, 9, or we touch 10, I think that's obviously a function of, how we implement some of the strategies that we are sort of unfurling. Yeah. So that's the ballpark where it is there. That's how we see the full year, 25 sort of pan.
Okay, all right. Hi, Rajiv. Good morning and good to see you. And so going by the numbers you're giving us, volume growth of 12 to 15%, high single-digit revenue growth means you're factoring in another price cut of around 3 to 4% for the year, right?
Well, we are not factoring in a price cut because remember that the price drops that were taken in December and in January. So that's going to pan out till December this year, right? And then we will have to look at. But what I'm factoring in is the fact that there could be possibly a bit of a slight mix change. Remember, for us, we are a premium brand. We are a premium large town brand. And obviously what we've been doing, and I've been talking to all of you, yourself, Prashant, Sonia and Surabhi over the last, is that we are trying to get into smaller towns. We've now touched 5,000 towns and we are moving to 5,500. So obviously, as you go into smaller towns, the mix will slightly change. It will have a higher constituent of, economy and mass. As I said, our focus is to drive and consolidate market share. We are not going to let go of the India market. It's a critical market for Akzo Nobel Global now. So we are going to fight tooth and nail and make sure we consolidate and grow our market share. We've done that in the full year. In fact, we've got about a 0.3% market share gain in the full year that's just ended.
So what's the market share right now? If we could quickly get that number.
We are now crossing almost about 4.6, 4.7%. We were at 4.2. We are really building it back. My belief is that, look, I think we want to, in the paint side of the business, we want to take it to at least a 5, 5.5 in the next couple of years. And we believe that we will, because our products are good. Our biggest belief is that we've got the best product in the industry.
Okay, all right, Rajiv, this is Nigel on this side. It's been good speaking to you. Thanks a lot for joining in and giving us all those details. We'll hold you to these numbers. Absolutely. For the time being, we'll slip into a short break, come back, refocus on the commodity space. Manisha's waiting for us.
Welcome back. Well, the equity headline indices are absolutely flat, not doing much. There's just, one stock that's catching the eye, and that's Mahindra and Mahindra. But the mid-cap screen is very, very vibrant, as Prashant has been saying, and lots of high flyers around. But for the time being, let's move to the commodity space and find out what the cues there are looking like. We have Manisha with us in the studios now. Manisha, what's on your radar?
Surabhi, thank you for that. Well, everything in commodities also has been flying around. We've been talking about metals for a very long time, but energy as well for this week has been on the positive side. So after three weeks of decline, crude oil prices are headed for a weekly gain onto this one. Well, there are signs of global demand improving. The supplies are on the tighter side, and all data indicates that for this quarter, you could be looking at demand improving. So starting right with the US itself, where we have seen the crude oil, gasoline and distillate stocks decline, clearly has been supportive. When you look at the US crude itself, we have seen inventories decline by 3.1 million barrels. That has been supportive. Not just US, well, we have seen the Singapore inventories also decline to almost 3-month lows when it comes to middle distillate fuel stocks there. When you look at the European markets here as well, we are looking at the gasoline stocks down by 7.5% in the matter of last 1 week. So whether it is about Asia, US or Europe, you have seen decline in energy and product inventories there. Add to that the Chinese markets have increased stimulus $1 trillion, by the way, in sense of bond issuance. And the Chinese imports and demand for most of 2024 have been on the positive side as well. Apart from China, it also has to do with the soft US inflation readings. Well, that is supporting buying. The dollar index is slightly lower, and the markets are anticipating that you could be looking at the first US rate cut coming for the month of September. And most importantly, the US Atlantic hurricane season is likely to be the most active on record. When you look at the numbers, the latest data that has come in from the meteorology department, from there, it is going to be about 25 named storms, 12 hurricanes that are forecasted for 2024. And when you have this kind of a data, and even if one of these storms or hurricanes is bigger than the other, then there are concerns about Gulf and the oil facilities there. The US summer driving demand season also is expected to be positive for the prices there. The only bit of a concern is the US retail sales data and the investment numbers. Well, that has been slightly disappointing, and is the reason there is some profit taking that we've seen in the Asian markets right now. But then it is all going to be about the OPEC and allies meeting in the first week of June on whether or not are they looking at further cuts, or they carry on with their production cuts for the second half of 2024 as well. That is where you will get the next cues from.
Okay, all right, Manisha, got that. Thank you very much for the details there. Well, with that, we do have to take another very quick break. Come back on the other side, and we will get chatting with the management of NCC and talk about their fourth quarter performance.
Welcome back. As promised, let's focus on NCC. We're joined by Mr. Sharma, the head strategy at NCC, who joins us on the show. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. Well, I wanted to focus on two aspects. One is on your margins. You know, out there, they were a little bit lower in quarter four, a little bit subdued, and it appears even your guidance is a little underwhelming. Tell us why about this, and also when do you get to double-digit margins? And the second factor is your order inflow guidance as well is a little bit subdued. Why is that? Because of elections?
3-4 questions, Nigel. Very good morning.
Two only, sir. One is on your margin guidance as well as on your order inflow guidance. Both of them. Please address it.
Only the margin guidance, not the past. You also talked about Q4 guidance is a little subdued. So I wanted to comment on that. Okay. Let me start. You know, at the start of the financial year 24, we had shared three numbers with you. The first number was order inflow guidance of 26,000 crore. We have been able to hit that number comfortably. The second guidance that I had shared with you and the street was revenue growth of 20%. We have hit that number as well. We have delivered really a growth of, about 35%. The third goalpost that we had shared with you was the margin guidance of, about 10% EBITDA margin. We have comfortably hit that number as well. See, if you are only looking at Q4, you have to also understand, the kind of cleanup that we have done in the past year. Every time that I came to your show or I got an opportunity to talk to an analyst or an investor, we got asked these questions about, these legacy issues. For example, the Concor, what is it? When are we really planning to settle that? The second question that was always, thrown at us was about Taka settlement. So I am happy to report that, we have been comfortably able to settle all these legacy issues and at the same time, hit the margin guidance number that we had shared with you. Now coming back to the guidance, we have again shared three numbers with the street. The first number that we have shared is the order inflow guidance, that is 22,000 crore. The second guidance that we have shared with the street is revenue growth of 15%, upwards of, 15%. The third guidance number that we have shared with you is about the margins, that is 9.5 to 10%. See, the elephant in the room for this financial year 25 is the election, being an election year, I am a keen watcher of, your show. Day in and day out, we are talking about the fact that, this is an election year and about 4 or 5 months, the government would freeze. There won't be, decision making, so that is the reason we have not really, brought the guidance down. If you really extrapolate that number by 30-40%, it's a very good number, it's really a growth. If you really extrapolate all these three numbers by 30-40%, we are talking about a growth, not a subdued guidance at all.
No, I mean, we were not extrapolating, Mr. Sharma. We were going by absolutes, and therefore 22,000 versus a total order intake of 27,200 crores of the previous year. I mean, it was, straight away looking like a dip. But anyway, I mean, let's just talk about, some of the qualitative factors as well. First of all, are you expecting things to pick up? I mean, is it just that you're being really conservative? In June onwards, are you expecting awarding to pick up? And which will be the key segments for you, which will drive a lot of the, the tendering?
See, maybe it could be June or maybe it could be July or it could be August. But our considered view on this space is, this infrastructure story is not a story about a quarter or couple of quarters or a couple of years. This story is something that is going to play out at least for 4 or 5 decades, So my guess really is as well, as good as yours, but our considered view is, maybe it could be July, maybe it could be June, or maybe it could, but we continue to see very healthy pipeline of projects or tenders, which are really expected to bid out. There may be a delay, maybe a couple of months here and there, but we are quite confident of, this pipeline being very healthy for next couple of decades at least.
Okay, unfortunately, we have run out of time on the show this time around, Mr. Sharma, but we would like to kind of squeeze in. Nigel, you have one last you want to
No, I
push
just
in over
wanted
there?
to tell Mr. Sharma that he's doing the right thing, with regard to business. We've taken his points on board. And as he said, he's always tuned into the show. So keep that going, Mr. Sharma. We'll invite you the next time. We'll have a longer chat as well. But thanks a lot for joining in and clearing out some of those issues. Well, for the time being, though, we'll wrap up on this edition of Bazaar. You stay with us. Chartbusters comes up next. Mahindra and Mahindra zooms